Good morning, deed grabbers. Glad to have you join us today for Goat Talk. Goat Talk is our weekly Facebook Live training. We usually bring someone on to talk to you about all things real estate related, subject to creative finance and that sort of stuff. We got a great guest today. We'll get to him in just a second. What is going on out there, guys? If you're in the marketplace, it's been so tough for so long, but I'll tell you, man, this week has been crazy. We just went through a list of 1,000 calls with a cold caller. And gosh, we got one contract we're going to get today. We sent out another contract last night and 3 more possibles that look really good. So is the market finally loosening up a little bit? I don't know. Our guest today is going to talk to us a little bit about that, what to expect, and how to help some of these people that are coming off of their forbearances. So if you guys are with us, hey, Phil, Arthur, good to see you. Screen is frozen. Gosh, is it working now? I don't know. Let me know. Good to see you in here. If you're with us this morning, I see there are a few coming on here. So introduce yourself. Let us know who you are and where you're located so we can say good morning. Subscribe to us on YouTube and watch us over there. Gosh, I don't want to get in trouble with the Facebook police here, but Facebook really limits how many people that they send this stuff out to. If you subscribe to us over on on YouTube, and you can do that right here, then you'll get notifications from those guys, and they don't seem to care who watches us. So that's a good thing. Hey, Don, good to see you, man. How you been doing? Haven't talked to you in a while. Tom is in Kennesaw, Georgia, man. We got a couple of Georgia people on here. That's great. Okay, so our guest today is a Sub2 Max student and also Sub2 Deal Show sponsors, guys. If you haven't subscribed to our podcast, do that. But he's one of the guys that makes it possible. Hey, Sam, good to see you too. Okay, Kevin, we're going to bring you in here. Kevin Strong with Strong, Jacob and Associates. How you doing, Kevin?
I'm doing great, William. How are you doing this morning?
Man, we're finer than frog hair.
You start off crazy.
Right. We are. Have you ever seen frog hair? It's pretty fine. So yeah. We're wrapping up this phase of the Epic Tour in Portland, Oregon. Gosh, we're getting ready for some snow here. Can you believe it? It's gonna snow for a few days.
I see you're on fire with those Sub2 contractors, man. You got about 4 or 5 deals working in 1 week.
I know, it's amazing. It's been, we've for the last couple of months anyway, pulling lists, couple of thousand, and have running those through, and maybe. And man, this week, that's too much work. That's a little tough. It's a little tough for me. But today we're going to talk about loan modification. And, a lot of these people are coming off of their forbearances. And what do we do now? So Kevin's the expert there. He's got a study course on it. He helps people with loan modification. So we're going to get going. If you guys have your questions, post them in the comments. We'll get to those today, or most of them anyway. We'll try. So Kevin, man, let's don't keep them waiting. Tell us a little bit about you and how you actually got into the loan modification.
Okay. So for those of you who don't know, I started my business back in 2005 as a result of back then I had some financial issues. I wasn't aware of what some of my loan mitigation options were. So I ended up losing my home, to make a long story short, in 2005. And that kind of got me interested in the debt management, debt settlement, loss mitigation, loan modification, things of that nature. So out of that experience was born Strong, Jacobs and Associates. So My core focus right now is loan modifications and student loan rehabilitation, which is on hold. If everybody's familiar with what's recently come out with the president extending that repayment period to May, I think, of this year before they have to start making those payments. And so that's basically what I focus on. So yeah, we do that very well. I have a course, a DIY course that basically is a cradle to close that teaches distressed homeowners how to negotiate with their lenders in the area of loan modification. And we also have launched within the last 30 days, which has done quite well. And I will give William credit for this, a full service model, because that's really about 75 to 80% of what people want. They really don't understand the process, or they're somewhat apprehensive about talking to a lender when they're behind on their payment. So we're able to work that and come up with some creative ways to get licensed attorneys in each prospective state. So we're able to basically circumvent that pre-foreclosure law that you've spoken about earlier. I do the consultation with the homeowners, but when the actual offer gets sent off to the lender, it's typically 9 out of 10 times done by a licensed attorney. And we factor that into our pricing. And that's how we were able to offer a full service product.
That's great. I know when I first met Kevin and talked to him, and he told me about his product, it was mainly a do-it-yourself thing. And I said, listen, there's one thing I've learned about products like that, even things people need. I know in my business, I'll think, okay, well, that's simple. I can do that. But then we get into it and it's like, man, this is way too much trouble. Let's just hire somebody to do it. So that's what we do. Hey, Dana, good to see Dana. Dana's in Alpharetta, Georgia. There's Phil Smith. Phil out in California. Look at this. Merry
go Christmas.
Okay, we got Allie in here. Allie, what happened when you authorized StreamYard for Facebook? Now we can see your name. Now we know who you are, so that's great. All right, so good to see you guys. Again, if you have any questions, just let us have those in the comments. So tell us, Kevin, what is a loan modification?
In simple terms, loan modification is a restructure of your original terms and conditions of your mortgage. Hopefully, for those that are successful and able to get one, it's going to be a permanent change. But sometimes, normally, there's what's called a trial period. If you are granted a loan modification, a lot of times the lender is going to want to see that you're able to make the payments for 3 consecutive months, and then they'll go ahead and convert it to a permanent term. So basically, it materially changes your original terms and conditions of your mortgage.
Right. Okay. You know, with COVID and everything else that's been going on, and all of the foreclosure moratoriums, we see a lot more sellers that want to sell now that have enormous arrearages. I mean, you know, in the past, picking up a house where they had 5,000 or 10,000 was really simple. Now, common numbers are 25,000, 35,000, $40,000. And so one of the questions we get a lot from students is it possible to work out a loan modification in a case like this, then take it subject to? And absolutely it is. But the key here is, as you just said, the homeowner has to qualify. They have to be able to prove the income to make the payments moving forward, whether the lender puts the total arrearage on the back end of the loan, or they restructure the loan, or whatever they do. It sounds like there are many types of loan modification, but the homeowner has to be able to prove the ability to make those payments moving forward. Is that correct?
Yes. So ironically, there's someone in your group, the Facebook group, not the private coaching group, that I'm working with now and getting ready to help one of his clients as he's getting ready to acquire this property subject to. And this particular homeowner is about $58,000 in arrear. So you're right about these numbers being big. So this is way I would like to kind of lay this out for this this forum today, and you guys can jump in and ask any questions. So from the macro standpoint, about 60% of the loans are done with federal banks, right? And you got the other 40% that fall under what's called non-qualifying mortgage, or private lenders. Lenders such as, let's say, Quicken Loans, Loan Depot, Penny Mac, Home Bridge, those type of lenders that are private lenders. If your clients have that type of mortgage, they typically don't qualify for some of these special loan modification programs that were offered as a result of the CARES Act.
Mhm.
So let's start with that. One of the big problems that I'm running into that a lot of people don't understand is that if you were 90 days or more late prior to March of 2020, some of these COVID-related special loan modification programs that the government is sponsoring through the CARES Act, your client doesn't qualify.
Mhm.
So one big bucket that you need to understand is that when you're in forbearance, you're actually considered current.
Mhm.
You're not late. So if you were paying your mortgage on time leading up to COVID, March of 2020, and then you went into forbearance, it's incumbent upon you, which is almost too late now, to work out a deal with your lender before forbearance expires. Because if you don't do that, when you come out of forbearance and you're asking for help, which is what most people think the way the process is going to work, your lender's going to tell you you're not late, you're no longer in forbearance, so you don't have a COVID-related hardship.
Right.
And if you say you can't make your payment, they're going to start to foreclose on you, or you're going to have to come up with some type of hardship,
Right.
financial situation to explain to the lender why you should have your mortgage reduced. And that's going to be very, very difficult because it's called a strategic default, which is something we don't encourage people to do. You're going to have to basically come out of forbearance and then be late for 90 days in order for the squeaky wheel to get the oil.
Right. I got you. Okay. So there are a lot more rules to this than most of us are aware of. So
Absolutely.
And are there currently any forbearance programs still going on? Have all of them already ended, or are there still some out there?
My understanding is that the large majority of them are going to expire next month. Some people are getting out of them at different phases, but most of them, if not over 95% of them, should be done by January of 2022, unless something comes up in the 11th hour, like what happened with these student loans in the last couple of days. Remember, he pushed it out to May, and those were supposed to resume payments at the end of January. So as it stands right now, most, if not all, forbearances should be over in January of 2022.
Okay. All right. So, comparing loan modification to some other things, what are the steps involved? Okay. Let's say that I get a call from a seller, I go meet with them, find out that they're $50,000 behind. What would typically be, just briefly, the steps involved in getting a loan modification? How long do these things take usually?
On average, I've gotten some done within 45 days with no docs. Those are special type of loan modifications. I'll go into that later in the show if we have time for it. But on average, if you're going to be submitting financials, you're probably looking at anywhere from a 2 to 4 month process.
Wow.
In order to get that completed. So you would probably, as an investor, want to ask your client, were you late prior to March of 2020? And if so, how late? Was it 30 days, 60 days, or 90 days? Because that's going to have a lot to do with whether or not you can offer something that's going to be a little bit more affordable in terms of being able to repackage all of those missed payments, either on a standalone second mortgage or have it worked into a new mortgage and have that extended out to a 30 or 40-year term to make the payment a little bit more affordable. So I would start off with that. And then from that, the follow-up question is, are we dealing with a conventional or an FHA/VA law? Because there's different pathways you want to approach it based on that.
Right. It sounds like almost like from previous conversations we've had and our experiences with loan modification in the past, that this whole COVID experience and environment has really changed some of the rules with loan modification. It sounds like they've changed some things and how they work. Is that the case?
Yeah. So there's something out there that's called a flex, and you guys can Google this, a flex loan modification. And that's normally for those that fall under conventional loans. Now, there's a plus and minus with that. Typically, it's a streamlined loan modification, which means that if you qualify for it, there's no documentation. There's obviously some paperwork. When I say no documentation, no financials from your client, i.e. tax returns, pay stubs, banking statements. None of that stuff has to be submitted with your loan modification. But The problem with that is that a lot of times the main purpose of a flex loan modification is basically to kind of reinstate the loan. So a lot of times your payment's probably going to go up. Mm-hmm. They're not really giving you a standalone second or something like that. So right. If income or affordability is an issue with your client, that might not help out as much. But from an investor standpoint, if you can find some way to, even if the payment goes up a couple $100 and get that reinstatement or that money that was in the rears worked into the new deal, and it still cash flows for you, it still may be a doable deal and a better deal for the investor instead of he or she having to come out of their pocket to make up those back payments.
Right. We've got a question here. Can you substitute a loan that's been modified? The loans I have seen say that you cannot sell or transfer ownership.
Well, that's a tough one. William, I'll let you kind of answer that too, because that almost falls in the line of a due on sale clause type thing, if I'm not mistaken.
Right. Yeah. So, well, you know, and when I first read that, I mean, I smiled because, well, they tell us we can't do a lot of things. You know, I'm not much of a rule follower. We're not supposed to take loans subject to. They tell us in there that any transfer of ownership triggers due on sale clause. What I have seen more of in the past is where, for example, maybe someone bought a house with some type of grant money or local situation, and they had a second mortgage on there, and it said at the time of sale, you know, or at a certain point, this thing has to be paid off right away, or whatever the case may be. I would look at that paperwork carefully and see exactly how would they know if the property had transferred, let's say, to a trust. I don't know if you use a trust or not, but we do that. You know, and a lot of times when I've had students in the past that have had these come up, it's been, well, it's a small amount, it's 5,000 or 10,000 or whatever. And if it's a situation where, yes, a transfer will make that loan due and payable right away, and they will want to collect it, then, you know, you may just have to determine if that investment is worth it to buy that property. But in most cases, I would say, you know, the loan's just going to stay there. I mean, I don't think they're going to call it due, especially if it's a second or something like that. I just don't think they're going to do it. But read the paperwork carefully. If you've got an example of one, send it to me. I'll take a look at it. I'll tell you what I think about it. But taking over payments on a subject to after there's been a loan modification done is something that's happened a lot, especially during this COVID situation. So I wouldn't worry too much about it.
One cap or one summary point about the flex loan. I was just looking at some notes because there's so much involved in this stuff. So forgive me if I kind of look down. Yeah. Here's a general rule. You take the unpaid principal balance and you divide that into the property value. So for example, let's say the unpaid principal balance on a flex loan, a conventional loan, was $400,000 and the property was only worth $300,000. That's 133% LTV. So the person's underwater. If that's the case and the lender buys that value at $300,000, then the way that's going to work is that they're going to take 30% of the unpaid balance, which is $280,000, and amortize you a new mortgage based on that amount. And the other $120,000 will become a balloon payment due at the end of the loan. That's only when somebody's upside down.
Yeah. So, well, I mean, you know, you talk about that kind of underwater. That sounds like a short sale to me.
It could be, but I'm just giving you an example of how the numbers work. Right. They can be a lot closer than that. So the general rule is that when you take the unpaid principal balance and you divide it by the property value, if the equity is between 0 and 20% on a flex loan, your payment's not going to go up that much, and they may put their rears in the back, and they won't jack your payment up that much.
I got you.
With a flex loan, if you have more than 20% equity, your payment's going to go up substantially.
I got you. Okay, I see what you're saying. Have you seen many of these? I know in the beginning of COVID, when they were encouraging lenders to work hard with homeowners to keep them in their houses, they'd also thrown out there extending loans to 40 years. Are you seeing that happen a lot now? Amortizing
Not
over 40 years?
Not that often, William. And I just had a client yesterday that qualified for, and I'll get into this later if we have time, you know, an FHA COVID-19 advanced loan modification, which sounds really fancy, but basically, if all the boxes are checked for this particular loan product, you can reduce the principal and interest payment by almost 25%. And you don't have to submit any financials. Well, these banks are telling these people that they don't qualify, even though they have FHA loans, and they're 90 days late with FHA loans. So you know as well as I do what the government tells these lenders to do, and then what they actually do when they're working with homeowners is totally two different things. So I've seen several that have been 40-year terms, but most of them are getting restructured around the 30-year mark. The 40, in my opinion, has been the exception more so than the rule.
Okay. So we got another question. Are they still doing forgiveness amounts in stages? Example, in the past, 3 annual installments of forgiven amount as long as borrowers comply on payments with no lates.
Reread that one again. That was a long one.
Yeah. Are they still doing forgiveness amounts in stages? For example, in the past, 3 annual installments of forgiven amount as long as borrower is compliant on payments with no lates. I need a little bit more information on that. I'm not aware of anybody forgiving.
That sounds like principal forgiveness or something. Yeah, none of the lenders are doing that right now.
Yeah, in this market, that's amazing. I've never heard of that, so I'm not sure. Tell us a little bit more about it. Go to StreamYard.com/Facebook and click that button. We can see your name and know who we're talking to there. So you're saying a loan modification, you're saying most of them are taking 45 days to 4 months. That sounds a lot like short sale too. Is that more? No, I'm just saying, I'm just trying to compare all the different possibilities for people, especially someone, if you buy a house today, and unless you're in one of the super hot areas right now, and you know, you just stop paying, and 2 years later, you're $50,000 in arrears. Most of that's interest and fees and inspector fees and all that other junk they pile in there. Chances are you're probably underwater at that point, or certainly don't have any equity at all. So that's just what I'm comparing those two. So are loan modifications taking a lot longer than they used to?
Not really. Like I say, the ones that fall under the no doc, ones that don't require the homeowner to submit their financials, those are pretty much getting resolved in less than 60 days, sometimes 45 days. It's the full doc ones that typically I tell clients anywhere from 2 to 3 months, or it could be longer. We don't charge anything up front on the full service side. There's a fee. I'll discuss that with somebody who's interested in it. But typically, how that works is that the client puts that amount in escrow, and they just have to sign over a power of attorney that authorizes me, or if I have to sign it to an attorney in that particular state, authorizes them to negotiate the deal on their behalf. And then if we're successful in getting them a loan modification, then the escrow instructions are to release that money to my company. If we are unsuccessful, then the money goes back to the homeowner. So
let me ask you this: if you're comfortable sharing this, what percentage are you guys able to get done these days?
The ones that I qualify, it's gone down a little bit. 4 months ago, it was at about 82%. I'm at about 75. So about 3 out of 4, and it's all about qualifying.
Right. So you're doing okay. So you're like getting some intake stuff before you say yes, I'll take your case, basically.
You know what, William? It's funny that you said that. I told one of the guys that was in your group that I'm getting ready to help out. The easiest way to look at this, think about when you go to a personal injury attorney and they says, I'll take your case. If they're pretty sure they can win, that's why they say, hey, I'll get my fee out of your settlement.
That's right. Those contingency, you're a contingency lawyer.
No, I'm not an attorney.
That's right. Yeah. Listen, if I'm pretty sure I can win, I'm going to take you on. So, okay.
Exactly.
And that makes sense, because you don't want to spend a lot of time chasing after stuff. You're not going to be able to help them. You wasted their time. They could have looked at other options. So let's get to how this loan modification, giving you a call, getting set up with you, or taking your course, how does that help an investor? if I'm an investor out there, I'm talking to foreclosure clients, I'm running into all these people that have high arrears, and I'm like, man, I can't put $50,000 into a house to bring it current. How can the average investor utilize this in their business to buy more houses and make more money?
We've talked about this before, but for those of you who are, with us for the first time, William has a saying, bring a heart to help. Mm-hmm. I think that's how you said it, right?
Yeah. Always approach first with a heart to help.
Okay. Right? So having that in mind, please understand that those investors who want to use loan modification as an additional tool in their investor toolbox, this is delayed gratification. This isn't something, if you're truly doing it to help the homeowner, then you give them the tools to save their home. The easiest way probably to do that, like I say, I have a referral link, but most people recently are just reaching out to me, especially since they heard of this full service thing, and be like, Kevin, just work it. And I pay people a referral fee upon me successfully negotiating the loan modification. So the way it helps the investor is that you pretty much can have a competitive advantage when you start talking to these homeowners who are distressed about how you can help through loan modification, getting yourself educated about loan modification, so you have some tangible information that you can share with your prospective client to gain some trust and rapport, even though you may not ultimately acquire that property 3, 4, 5 months down the road. Because I'm here to tell you, statistically speaking, even if you get a loan modification, over 60% end up defaulting within the first 12 months anyway. Now, that's a sad thing to say, but at the end of the day, from an investor standpoint, as you start to help these people and they have to ultimately come back to you for an exit strategy because they can no longer afford the property, you're going to be in a much stronger position to not only negotiate, but probably work out favorable terms that are going to turn out to be some really good monthly cash flow for you.
Yep, exactly. That's what I've always taught students. If I go in first with somebody, because what takes away most investors' ability to close on a pre-foreclosure deal is because the homeowner wants to keep the house. It's not because they won't deal with them. They just want to keep the house. They don't want to sell it. So if I'm already standing there at the door, or I'm in the living room sitting across the coffee table from a homeowner who really wants to keep their house, I can ask a few questions and determine if me making a call to the bank for them will probably be able to help them in some way, whether that's a loan modification or just talking to the bank and get them in touch with the homeowner so they can complete the process. If they do that and they're able to keep their house, then that's great. Obviously, I'm not going to get to buy it, but you threw the number out there, and I'll tell you that's pretty close. My experience tells me, that about 70% of people in foreclosure will be back in 12 months because they're not going to, even if the bank works with them on modifying their loan, they're not going to change poor financial habits. And a certain number of people get in trouble that's none of their fault, but by and large, it's people that just don't manage their money properly. That's really where it comes from.
Exactly. And any of you guys who've been following me either in the private group or on William's Facebook sub-2 page know that I'm a big component. It all comes down to income. Mm-hmm. I don't care what kind of program you got, how much your principal and interest payment can be reduced. If you don't have sustainable, verifiable income, you may be in that property temporarily, but in the long run, unfortunately, you're going to lose that property. And as an investor, you want to be there, as William indicated earlier, with a heart to help, saying, hey, I'll help you all that I can. Like I say, I do encourage investors to get educated about the loan modification process so you can give them real information. And it's not just something that they can find on the internet. So here's an example of a gem. A lot of people who are not making their mortgage payment obviously stop making their homeowners insurance payment. Well, the bank has to cover that asset. So normally over a period of time, they'll do something that's called a forced place insurance plan. And they'll put insurance on the property to cover their asset. So typically speaking, that insurance premium is 4 to 10 times higher than what it normally would be if they were paying it on their own. Now, the servicer / lender is required to give the homeowner written notice that they're about to do this forced placed insurance on their property and give them an opportunity to cancel. So one nugget you can tell a distressed seller is that, hey, even if you can't afford your payment, you need to cancel that forced place insurance and pay at least a homeowner's insurance, because
Right.
that astronomical amount of premium that's getting added on, that's also one of the big numbers that elevates the unpaid principal balance. When they start tacking on all these fees and penalties, it's
Right.
the insurance part of it as well. So
That-
even something as simple as that could be very helpful to the homeowner.
Yeah, that forced placed insurance, man, is outrageous. And all it protects is the lender. It doesn't cover contents if your house burns down, all your stuff's gone. And it doesn't give you, if you do have equity, it's not going to pay you for it. So, man, that's some nasty stuff there for sure. Frank had a question. Can you give us an example that talks about how the late fees are being calculated? So if the monthly mortgage payment is $1,500 PITI, how much ballpark are the late fees?
That I don't know, Frank, to be quite honestly. That's something internally that the bank uses, and everybody knows that they're tacking on shit. Excuse my language. I think we can say that in this format. And it's like a net present value, something called NPV, which is a very mathematical, high, like really, really calculated number in terms of whether or not they're going to do a loan modification for you. So there is no public information from an investor from the outside looking in to determine how they calculate those fees. That's something that's done internally within the bank.
And I'll tell you this from experience too. The more low rent the lender, the higher the fees. It's just like credit cards for people with bad credit, that have all these late fees and stuff like that. And that's the way lenders are too. If you're looking at a B or C lender or whatever, they're gonna have some astronomical late fees for sure. He had a follow-up question. I believe loan modification is only going to work when the hardship is temporary, 2 to 3 months, and the arrears is very small to begin with. What do you think? I don't know if that's true now. I've seen some pretty big arrears fixed with a loan modification.
So that's not necessarily the case, Frank. Like I said, the one that I'm getting ready to work on with this guy that's part of William's Facebook page, this client is about $58,000 in arrears. And we're probably going to be able to get it done. So here's an example. If you're dealing with FHA, because the first example I gave you guys was kind of like the flex loan, and I didn't really want to get into all the math of that because, this is just not the format for it. But here's an easy thing to think about it. An FHA, if your client has an FHA mortgage and they're 90 days late, either before, during, or after COVID, there is a product that may reinstate the loan. And when I mean reinstate all of those back payments, or do a partial claim, which means they'll take that amount that was in the arrears and put it as a standalone second, 0 interest, and then that portion isn't due until you refinance or you sell the property. And the person may qualify for a 25% principal and interest reduction on their payment, not the escrow amount, just the PI. And here's the beauty of this one. No financials have to be submitted. So you can have somebody with an FHA loan that's 90 days late, looking like they're about to hit the default, and they may qualify for this program, and it could potentially save their home. Now, getting back to the income aspect of this, if the person is just flat out, income is just busted, and even a 25% reduction isn't going to save the house, if you acquire that via subject to, just imagine how much cash flow that adds to your bottom line. If you had your numbers here, and then after this FHO COVID loan modification program, the payment gets reduced by another 25% on top of that.
Right.
That's huge in terms of cash flow. So once again, it's a 90-day late FHA program. Mm-hmm. There's a little bit more involved to it, but typically that's the first question. If it's FHA, and are you 90 days or more late? Even if you're 4 months late and you're facing imminent default, this person still may qualify for this program. Reinstatement, partial claim, 25% PI reduction, and no docs required.
Okay. Is this a program, Kevin, that's going to stay around? Is it COVID, is it COVID specific, or do they have a plan to end it, or will it be ongoing?
I think it's going to be a while on for a long period of time. And I think part of this, the watchdog that's overseeing this particular program is the Consumer Finance Protection Bureau, the CFPB. So when lenders don't want to play ball, you can write a letter to them, to the CFPB, kind of get them involved. And I've done like 3 of these so far. within the last 2 months, and I haven't had any issues. What's happening is that obviously lenders aren't telling people about this stuff. Because people, right? People are calling in, and the person on the phone that probably makes $15 an hour doesn't know all these programs and telling these people, well, you just have to get current on your payment or we're going to foreclose on you. And that's not necessarily the case.
Gotcha. Looks like we've got someone here that's worked with you before. I don't think that's his name, but he said he was able to help qualify a couple who were 11,000 behind over 4 years, but they did have to qualify. It was an FHA, and he says that you helped him with that. So I'm not sure who that is.
I appreciate that, brother. Yeah. So on a different note, here's some of the main reason why loan modifications do not get approved is a lack of income. Mm-hmm. Okay. And part of my course, the DIY course, comes up with creative ways to help improve those numbers. So I talk to people, or once again, as investors, here's a tip that you can tell these homeowners. If your income is a little short, if you want to rent a room out, rent a room out. Get a standard lease, put it in writing, don't take cash, get a check from that person and deposit that check into your bank account. So when you go to submit your banking statements to the lenders, most lenders will at least accept 75% of the rent as income. Right. Start to negotiate with your credit card companies or your car loan, any type of revolving monthly debt that you have. Reach out to those creditors and see if you can work up new plans or reduce those interest rates so you can flush out some more disposable income. Because at the end of the day, that's probably the main reason why loan modifications don't get approved is income. And the second one is probably paperwork, but I'll touch on that a little later if we have time.
Okay, yeah. So I know you had already, I think, addressed earlier when we were talking about a lot of states after the last foreclosure fiasco that happened in 2007, 2008, a lot of states put in protection laws to keep people from charging, because I know everybody had a little business out there where they would charge you $500 or whatever to get your loan modified or whatever the case was. And of course, most of them didn't produce anything. They took the homeowner's money and they didn't do anything. So now you have to use an attorney or somebody that, I know that's what you're doing. But if you're out there, if you're in a state maybe that doesn't have those laws, I'm guessing there are some states that will allow you to charge a fee if you want to help people. Yes.
This is my recommendation. I like to just keep it simple. I know you used to say, keep it small, keep it all. Right. I do listen to you, William. I tell people all the time, if you qualify up front, just don't charge anything. Mm-hmm. And if you're unsuccessful in getting the loan modification, keep that client up informed daily, weekly, however often it requires, so they're not holding the bag in the 11th hour thinking that, hey, William's going to get me a loan modification, and all of a sudden they get some paperwork that's showing that their house is getting ready to get foreclosed. So if you keep people informed and you don't charge them up front, you won't get any complaints. You also need to tell customers that if I take on your case and negotiate a loan modification for you, that does not necessarily stop collection activity or the foreclosure process. So don't be alarmed if you're still getting calls or nasty letters in the bank, even though somebody's actively working on a loan modification on your behalf. Sometimes it just works out that way. Now you can ask the bank, will you cease and desist on pre-foreclosure activity while we're trying to work out a loan modification? But most will probably tell you no. Right. They're going to still continue to go down that road.
Yeah. We've got the next question here, and I'm in total agreement with this. Kevin, can you share your email? I have questions. I believe in letting the professionals do what the professionals do. Okay. I'm listening to Kevin talk about all of these new rules and stipulations and all this stuff, different types of loans, different rules, percentages. And I'm saying, you know what? If I've got somebody that needs a loan modification, I'm just going to call Kevin and say, listen, you need to handle this. So Kevin, tell us how the best way for someone to reach you if they have questions about loan modification or about your course that you have on it.
Can I put that in the chat? Is that it?
Tell me, and I'll put a banner up here with it on here.
Kevin at strongjacob.com.
Kevin at jacob.com.
So to kind of pick up on what William was talking about, the DIY course, it was $297. It's $597 now. And that's not just because of inflation. It's just because of supply and demand. And William has told me on and off the record plenty of times, the content that you offer and the knowledge that you share in that course is way, way underpriced.
Right.
So even at $597, it's a deal. If you're in the coaching group, the Coaching Max group, I'm still offering that discount I did months ago for $197. If you're not in the Max group, it's $297. If you just want to refer, as William said, if your core competency is acquiring property and you don't want to deal with all this stuff, you just want to be like, hey, call Kevin. I don't want to deal with this. Upon successfully getting a loan modification for your client, and once we get paid, we'll give you a $200 referral for that. So that might be the path of least resistance for those for those investors who just don't want to spend any time dealing with banks and loan modification. If you just want to just say, hey, you handle it, and once you get something, just give me a referral. I will tell you as a full disclosure that the folks who are doing that, I keep the investor involved because some of these don't work out, right? So if William gives me an opportunity to get a loan modification for him and I'm unable to do so, he and his family have a very realistic exit strategy that they have to entertain. We may have to leave this property. So then the investor who originally referred this deal to me, I let them know immediately, you need to recontact with William because his loan modification failed and you need to work out some other type of strategy, whether it be subject to or however you're going to acquire the property.
Right. Okay. So we're trying to do a loan modification for a family, either so they can stay or so we can buy this property ultimately. What are some of the most common mistakes that we would make in getting that thing approved?
Paperwork. So let me be more specific about that. When the bank says, I want 90 days worth of your banking statements, don't send them screenshots. Don't take pictures of your banking statement with your cell phone. Download it he's laughing because somebody's probably done that. Download it in, the PDF format you can download off the website. Print something like that out and send it, and make sure it's a full 90 days. Because typically when you go into a bank and you open up a checking account, let's say on December 15th, that's your 30-day cycle for your banking statement. But most people don't think about that, or they forgot when they originally opened up the account and they go, oh, well, from December 1st to December 30th is a full month. So if you send them 2.5 instead of 3 full months, something as simple as that, they will reject. If they asked you for a W-2, I would strongly encourage you to make a copy of the W-2 and send the original into the bank. Right. So it's things like that, sloppy paperwork, or if they have a stacking order that they want the application submitted in, don't deviate at all, because this is a big, big bureaucracy. There's hundreds of thousands of stuff that's going on in terms of loss mitigation. And if your packet doesn't check all the boxes, it's easy for the loss mitigation supervisors just to say, denied, I'm not going to deal with this. Right. Because it's not in order.
So here's another thing that I've always understood to be true, and maybe it's not. Maybe you can help us with that. Can you get a non-owner occupied FHA loan or a vacant property done for a loan modification? Can you get that through?
Yes. So if you have an FHA non-owner / investor property, does that qualify for loan modification? Yes. So before you get excited, here's the good and the bad about that. You got to smile when you get bad news, right? Right.
Yes, you do.
The purpose of a non-owner occupied FHA loan modification is to reinstate the loan. It's not to make the payment affordable, which is what they do for people who have primary residence. Right. So what that means is that if this is an investor property that's FHA, and let's say you owe $25,000 in back payments, there's a good chance that they'll rework that program with you, but your payment's probably going to go up, and it may go up substantially. Because once again, the primary purpose of that for investors is to reinstate the arrears, not to make the payment affordable. So keep in mind, if you go down that road, don't expect your payment to go. If it's $1,000 and you owe $20,000 in back payment, your payment's probably going to go up to about $1,400. It's definitely not going to go down.
Right. Okay. So what about this case? Because this is more common case that we see. A house in foreclosure, it's vacant. We track down the homeowner. They've moved. It's a vacant property now. It was owner occupied, but it's vacant. Can we get that done? Or do they have to move back into the house? Because that's been a problem in the past.
Now that's when you say bending the rules. That's why I'm smiling. It's that, right? So that's going to determine, are you looking at the non-owner occ one where they'll do the reinstatement, but your payment's going to go up? Or is there some way you can be creative?
Yeah. Well, I know. And this is when they get you, though, when you have to sign an affidavit that says you currently occupy that property, under federal law.
That's a federal document. So, and it's just like VA loans too, right? People do that. I'm not saying they should, but people say, well, I intend to occupy.
Right. And
then, hey, something happens. But you're right. At the end of the day, there's probably an affidavit associated with residency. Right. And you're going to have to sign your name to one way or the other and be comfortable with that.
Mm-hmm. That for sure. And well, I mean, even when you buy a house with an FHA loan, they ask you, do you intend to occupy this property? Because I remember when I first got started investing, people would talk about, well, you can buy investment property, FHA, well, what about that statement that you intend to live in it? Well, we'll buy one, live in it for a couple of months, then something happens, we have to move, and stuff like that. I mean, people, I'll bend the rules, but when you start, around with the federal government and their laws, or when you test it, you sign something with your name that says, I intend to do this, then they could come back. It could be a problem. So you don't want to do that.
Your buddy, attorney William Bronchick says it best, right? He likes to quote, Beretta, don't do the time if you can't do the crime.
Yeah, there you go. That's exactly right. Okay, so our guy that was talking to us, that's Ethan. Okay, is this Ethan from Sub 2 Max? I think so, maybe.
Yeah, probably.
Okay. Yeah. All right. Okay, so that's Lori asking about your Lori. Go to StreamYard.com/Facebook, and we'll be able to see your picture and see your name, see who you are. So when you ask a question, if you guys have questions about loan mods, Kevin's the guy to ask. So we got a few more minutes on here to talk to him about that. So is there a way, Kevin? So if you're looking for people, and you can get a list for just about anything out there. So this loan modification business has always, in my experience, been something you stumble upon when you're dealing with people in foreclosure. Obviously, people in foreclosure aren't making their payments. But before COVID, it was common. Their arrearage amount was small enough you could just pay it up. For me, get that money back from my buyer's down payment, and I always made whole. But these $40,000 and $50,000 numbers make that impossible to do. So for me, that would be when a loan modification was important. So it's really just something that you stumble upon in dealing with foreclosure type situations where you would need a loan modification, I'm guessing.
Yes, the FHA and VA loans, those specific to government loans, are probably going to be more suitable to either do a standalone second or work out some type of deal where those hefty back payments won't have to be paid up front, whether by the current owner or if you decide to take the property subject to. Like I say, there's a lot of programs involved. But here's where I think, as we get near the end of the show, where I think is going to get really, really, really interesting. As I said at the onslaught, that remember, if you're in forbearance, you're not late. Mm-hmm. A lot of people that are coming out of forbearance, probably in January of 2022, are going to go to their lenders and say, hey, I can't afford that $1,000 payment that's been suspended for the last 18 months. But because you're asking that after forbearance, they're going to treat that like anything else. If you don't have the income to resume that normal payment, we're going to eventually start to foreclose on you. So once again, it's incumbent upon all investors to keep that in mind, that if you're talking to somebody who's coming out of forbearance, but they have an income issue, but they're not ready to sell their house, please keep them on your updated file, because it's going to happen. And it's going to happen in a massive, massive way, because there's this big misconception is that I can go 12, 18 months without making my mortgage payment, come out of forbearance, and then just tell the lender that I can't resume my normal payment. And most people are under the misconception that the government or the CARES Act or the Consumer Financial Protection Bureau has told these lenders that they must work out affordable payments with these people. And they were supposed to under forbearance. And the reason why people waited so long is that if you had 6 months left in forbearance, why would you proactively, on average, contact your lender, let's say get your payment from $1,000 down to, let's say, $850, because now you're making the payment. Most people aren't going to do that. They're going to say, well, hell, if I got another 6 months and I don't have to make a payment at all, I'll just wait till it's over with, and then I'll ask the bank, can they do something for me? And that's where I think we're going to see a lot of distressed sellers, where investors are going to have the opportunity to come in to either help with a heart to help or make sure they follow up with those folks. So somewhere down the line, they have an opportunity to acquire that property.
Exactly. Okay. We got a good question. Marina here says, have you or would you ever do a loan mod where one of the owners is deceased?
I've never done that. What's her name? Marina?
Marina. Yeah.
Marina. I've never done one of those. So I would actually probably have to find out who the next of kin is in terms of ownership and then go that route. But that's just me thinking off the cuff. I have no experience of doing a mod when somebody is deceased. But I would assume, William, you can pick up on this. It would just go the natural progression of who has, ownership of the property. Right. And if they didn't have a will, this is out of my wheelhouse. I guess would that go to probate if there's not something in order for that? So that could be a murky situation if they don't have their proper paperwork in terms of succession of who's going to acquire the property in the event of a death.
Okay. All right, Marina, there you go. Brad says, so before I send you a referral, the basic idea, if they qualify for a loan mod, is if they can afford the new payment. So does Brad have to do any pre-screening to send you a referral? You do the pre-screening, don't you?
Yeah, I'll handle all of that. Yep. I'll handle all of that. And if I'm communicating with that client by way of email, then you'll just be copied on everything. So you're kept in the loop as this thing is moving forward. So it's not like you're just out of it and waiting to find out what's going on. As I get updates and I update my client, if that's a referral, Brad, that you're sending to me, then you're going to get that update as well.
Okay. Well, there you go, Brad. Okay. Marina says, got it. Thanks.
Sorry about that.
Thank you, Marina. Matt asked, is there a place we can pull a list of people in forbearance?
No, Attorney Bronchek gave me a source last year. I think it's called Data Consumer. I don't know if you heard of them or not. They're kind of like a small operation. They're a little slow, but their data is pretty decent. But they can pretty much get you pretty good data on 30, 60, and 90-day lates. Mm-hmm. Okay. I think it's called Data Consumer or Consumer Data or something like that. You might want to ask your buddy about that. But I had some success with them in terms of how accurate the data was, in terms of finding people who were either 30, 60, or 90 days late with their mortgage.
That's a big problem with pulling lists. I know Pam in Sub2 Max had said some time ago that she pulled this list from a list provider about people that were 30, 60, 90 days late. And almost 100% of the ones contacted claimed they weren't behind. But that's a common issue with people in foreclosure. They deny it. They don't want people. I don't know what you're talking about. That's just something you're going to run into with those lists. I mean, if I'm standing on their front porch because I pulled the list pendants myself or went on the website and saw it, I have no doubt they're in foreclosure. They may still deny it. I'm not going to argue with them because I can't win that argument, and build any rapport at all. Listen, you're a liar. I've seen the document at the courthouse. Now, please sell me your house. It doesn't work that way. But that's what you're going to run into with those lists if you haven't seen the document yourself, for sure. Let's see. Frank had a question for you. It's a little off topic. He wants to know how you got that certificate of accreditation from the BBB on your website.
They sent that to me after so many years being registered with them. Thanks, Frank. I've been with the Better Business Bureau in the state of Washington since 2016, so it'll be 5 years. And I forgot what the period was. I've had that for several years now. So I think after like 2 or 3 years, as long as there's no complaints or anything like that, they'll issue that. I don't know if all Better Business Bureaus do that across the country, but I know that's how the state of Washington works. And the company, as I said at the beginning of the podcast, was started in 2005. So it's funny that you mentioned that, Frank, because I can tell people, and we didn't talk about some of the debt settlement things that I do in terms of removing judgments and liens. When you deal with attorneys or big creditors, and let's say I'm offering to or trying to ask for 20 or 30 cents on the dollar for my client, that attorney or creditor will do their research. So it's a benefit sometimes to find out, and I'm not saying this to brag or anything, but hey, this business has been around for 15 years. They're registered with the Better Business Bureau. They don't have any complaints. So things like this is favorable in terms of negotiations, and it's also favorable as an investor when you talk to your client and say, hey, I have somebody that I have a professional relationship with that could probably help you with the loan modification, and they're not a fly-by-night company. Mm-hmm. Do your research. They've been around for a while, and they're registered with the Better Business Bureau. That's a big confidence boost for a homeowner who's trying to decide whether or not they're going to let somebody handle their loan modification for them.
Right. It goes along with what we talk about all the time about when you invest remotely and you piggyback off of licensed real estate agents, closing attorneys, mortgage brokers, people like that. Same thing with somebody like Kevin, who is a member of the Better Business Bureau, because we're in a space right now that's full of crooks. You know what I mean? So really, so if you have that reputation, that's really important in what we do. It really is. Okay. So Sub2 Max student Tristan's in here. What's the deal for the do-it-yourself course? If I'm a coaching member, pretty sure I'll be taking the course. Also, if I find a lead and want you to be the loan mod contact, do I still get the deal? Yeah, Kevin, you just handle the loan mod, and then he can buy the house after that, can he?
Yeah. So the DIY course for coaching members, Tristan, is $197. If you're not a member, it's $297. If you refer a loan mod to me, as I said earlier, and we get it done, there's a $200 referral fee. If we don't get the loan mod, once again, you're kept in the loop throughout the whole process. So as the investors that I work with, I tell them all the time, I don't want my core competency is debt settlement, loan modification, and credit score improvement, all that other stuff. So I'm not trying to do any underhanded thing like steal an investor's deal. Like, you give me a loan mod, the loan mod doesn't work, and then all of a sudden I'm trying to step in to acquire the property. And Williams has known me long enough to know that obviously if there was any reservations about something like that, I wouldn't be on this show with him. So you don't have any worry that if you hand something over to me, will you get an opportunity to get it back in the event that a loan modification fails? Absolutely, you will. I'll totally keep you in the process.
Yep. That's right. Kevin's good people, so he wouldn't be on here if I didn't think he was. So there you go, Tristan. If you're a Sub2 Max student, you get the loan modification course for $197. Mm-hmm. And of course, if you're listening to this, I guess you can get it for $297. Is that right?
Yes, sir. Yes, sir.
Okay, great. And if you're interested in becoming a Sub2 Max student, you can check it out. Sub2dealscoach.com or sub2max.com will tell you all about it. Kevin's in there, and if you have questions about it, you can ask him. We've got a few other students that are on here that I'm sure would tell you all about it. We have a good time in there, don't we, Kevin?
We do. So for those of you who want to see what the new website looks like for the loan mod, because I have revamped it since the last time we spoke live, William, just go to preventforeclosure.us and you'll see some changes in there. And there's also a video that I put on there that kind of explains the three options that we're offering consumers in the area of loan modification.
Prevent foreclosure.
Yep.
Spell that wrong?
Nope, I think you're right. Oh, yeah, you did. Where's Jody when you need her?
I know. Where's my producer? My producer should be helping me out with this too. Okay, so it's prevent foreclosure, and I'm going to find this. I'm going to get this up here in just a second. Keep talking, Kevin.
What'd she say?
Never mind. So anyway, any last words on loan modifications?
I think it's something that's going to continue to be in the mainstream for years. I think it's going to start to trickle out starting January of 2022. And as I indicated earlier, those people that are coming out of loan, out of forbearance, that go 90 days late are going to be screaming for some type of relief. And I know some of the government loans, if you get a loan mod and you're making the payments, I think you can get another one if it's within like less than 2 years or over 2 years. So it's not a one-time deal. So this thing is going to be ongoing for a long period of time. What are you smiling at, William? Is Jody messing with you?
Oh, that's just my producer being goofy in here.
Well, that's healthy for a relationship. So in my humble opinion, yeah, I think this is going to be, I'm not gonna predict a massive wave, but I will say in confidence that I think we'll see a steady stream of distressed sellers who are unable to make their mortgage payment for years. That I am comfortable in saying.
Yep, for sure. Okay, guys, to learn more about Kevin and his loan modification program and his service that he offers, just visit preventforeclosure.us. You can also email Kevin at kevin@strongjacob.com. Kevin, we appreciate you being here today. We appreciate you being a Sub2 Max student and being a Sub2 Deals Show podcast sponsor. So thanks so much for being here with us today.
My pleasure.
All right, thanks. Hey guys, we appreciate you joining us today for Goat Talk. Goat Talk is every Thursday, same time, 8 a.m. Pacific. Too early. And of course, do your own time zone across the country. So till next Thursday, get out there, talk to some sellers, buy some houses.